table discussion this morning. And today, uh, we're talking about something very, very important. We're talking about how you can plan towards the end of the year. Now, as we count down the final days of the year, one thing is clear: December can be a blessing and a trap for many businesses. Around this time, sales go up, discounts are everywhere, expenses starts to rise, and before you know it, January is knocking with some bills, with salaries, rents, taxes, renewals, and all of that waiting for you. And so this morning, we want to help businesses end the year wiser, stronger, and also more financially prepared. And we are breaking down how companies can actually take a hard look at their numbers, manage their cash flow, track their real impact of promotions, and avoid unnecessary expenses and enter the new year without regrets. Because there's one thing every business owner and every business person must understand, and it is that December profits don't matter if January breaks you. So that's what we are going to look at this morning. And my guest is Mr. Nelson Kwagbeji. He is a financial analyst, and he joins me for today's conversation. Hi, Nelson. Good morning. Welcome to the Business Breakfast on Z.
Yeah, good morning and thanks for having me. It's always a pleasure being with you.
Yeah, thank you so much for also making time always when we call on you. All right, so let's get into the conversation. I want to look at financial planning around this time for businesses. Maybe first of all, why is that very important? Why is financial planning crucial for businesses as the year comes to an end? One would think that planning should be maybe at the beginning of the year and maybe quarterly, but why is it very important towards the end of the year?
All right, thank you very much. Financial planning is very important throughout the year. And the reason why at the beginning of the year, we present a budget, and the budget will guide us as to what to do within the ensuing year. And that same budget will also serve as a benchmark to compare the actuals against the projected. However, getting to the end of the year, financial planning becomes key because it actually helps businesses to avoid overspending. Once we are getting closer to the year, everybody wants to spend. But then if you don't plan very well, you end up overspending, and that may end up hurting your bottom line, which is the profit. It also helps you to prepare. You see, we are in December. If you are spending, then how are you going to prepare for January? And so it also helps you to actually reserve some of your revenue or funds for the beginning of the year. Because if you spend everything in December, when the year begins, you will feel the impact. So it helps you to also prepare for the bills in January. And also it helps you to actually monitor your cash flow. When I mean cash flow, I mean money that is coming in and the one that is going out. So based on that, you can make an informed decision as to how you will close the year and how you begin the year.
I see. So it's very important for businesses to pay attention to some of these things. How does discounts and some of these things around this time fit into that?
Well, the discount, they are just marketing strategies that intends to bring people into the business to buy more. And don't forget that discounts, they are expensive to the company, because once you are selling something at 10 cedis, but now you decide to sell them at 9 cedis, then it means that the 10 cedis, the 1 Ghana cedi, you have to absorb it. In any case, before a company can offer discount to a customer, a lot of factors are taken into consideration, especially the volume of trade or the volume of sales. If you are not doing so much sales, and he wants to give discount, then you should do it very well, because at the end of the day, you are in business to make profit. And so when the discount is too much, then it hurts your performance. So around this time, most especially companies that are into the electronics, companies that are into manufacturing, they give discounts to customers in order to, end the year well by boosting sales.
So, but is discounting and some of these things around some of the giveaways that we do towards Christmas, is it worth it?
Well, before a company who actually decides to give a discount, they will take a lot of factors into consideration, most especially the volumes that they want to sell. And so if you give a discount of 1 Ghana cedi on 10 cedis to customers, then that can lead to exponential growth in your volume of sales. Why not? And so, companies do it on case-by-case basis. I don't think any financial institution will be giving discount on interest rate that they quote on their loans.
Right.
It is mostly done by, people.
Retailers.
It's mostly done by businesses that are actually into manufacturing or the sale of electronics products.
Right. But just to still be on that particular point, what are some of the considerations, the key considerations that businesses must make before they go into discounting around this time?
Well, number one, they have to look at their sales volume. And so if at the beginning of the year till November, they haven't done much sales and they have stocks that are lying out there, and per their projection, they realize that they may not sell the needed volume, then they may want to give discount. Number two, some companies may also give discount in a way of sort of rewarding or thanking customers for the purchases that have been done during the course of the year. Number three, another factor that may push a company to go into, giving discount is when they are having old stock and they are getting closer to their expiry date. You just have to, reduce the price in order to sell those, products. So these are some of the considerations that goes in. And of course, the most important thing is that they also want to increase their volume of sales, because it's the volume of sales that will bring in the needed profit. So these are some of the considerations that, they may want to take into consideration. However, the discount itself is also a marketing strategy, because if you look at the electronics industry or the electronics market in Ghana, we have so many of them. I can decide to go to company A or company B or company B. And so once you are giving discount, your pricing becomes a little bit cheaper and competitive compared to other peers in the market. So that will go a long way to attract, customers to your place. So these are some of the considerations that they take into consideration before giving out the discounts.
Right. I'm talking about the discounts. I want us to stay on that for a few minutes, because I know a lot of businesses are trying to run it. I've seen SMEs, people on social media running their business, also doing some 15% off, 5% off, and all of that. So that's why I want us to speak to that particular one so that they take the right decisions. But how can they tell? Because now you said that the bottom line is that they want to boost their sales in December, and that is why they do that, even though there are some other reasons. How can they tell if a discount is actually profitable, or maybe just creating some cash flow illusions?
Well, it's all based on your cash flow projection. And so if the commodity, as I did indicate, is 10 cedis. However, if you sell at 9 cedis, you can still make some reasonable profit. Why not? You can still go in for it. But then the bottom line is that it's a marketing strategy. It's an advertising strategy to attract customers and boost sales. And before a company can decide to give discount, they have to sit down and do their cash flow projection. In any case, if you are giving a discount and at the end of the day, you are not making any profit, then why then do you go ahead and give a discount? So they have to sit down, do a lot of analysis, their cash flow, and then based on that, they can even decide the amount of the discount they are giving or the rate of discount they are giving. And if you go to town, most of these companies are running promotions and discount this time around. I'm sure at the end of the day, their cash flow projection tells them that, well, if I give a discount of, let's say, 10% on the 10 Ghana cedis product or commodity, I can still make the profit that I intend to make by the end of the year.
So is it advisable for struggling businesses to join the December discount race just to stay competitive?
Well, I think this thing should be done on case-by-case basis. If you are a struggling company, you are not making so much sales, somebody else is making sales and the person is giving discount. If you follow the crowd, you may hurt your bottom line. And so it would depend on the end of year marketing strategy of the company. However, if the struggling company thinks that if I reduce my price by, let's say, 2%, I can be able to break even at the end of the year, why not? Because nobody is into business to make a loss. We are all doing business to make profit and for the company to grow. And so if you are struggling, but you still think that with a 5% discount on my product, I can still break even or make a little profit, why not? They can still do it.
Right. Okay. So that will be all for the discount. I mean, if we're going on and some other questions come up, I'll let you. I mean, talk speak to them. But let's come back to the financial issues, the key ones. So, what are some of the most common financial mistakes that businesses make at the end of the year?
Okay. So one of them has to do with mixing personal expenses with business expenses. I mean, you see a businessman who is paying school fees from his sales. I mean, you don't mix them like that.
Right.
You have to clearly separate your personal family expenses from business expenses, because there is a concept in taxation that says that for GRA, they can only recognize an expense to be deductible if that expense has a nexus or is closely linked to the income that is producing the income. And so if you are paying your child's school fees or your personal travel expenses from your business income, that has nothing to do with the operations of the business. And so mixing personal and family expenses with business expenses is actually one of the mistakes that the business do. Then secondly, inability to monitor your cash flow. You see, if you are not monitoring your credit sales to, your customers, and not monitoring how much you receive at a point in time as against your expenses, then you are making a huge mistake, because at every point in time, there must be a match, not a mismatch between your expenses and your income.
I see. So how can they manage their cash flow better around these times?
Well, I think that if you think there is an expense that is not really important, you can delay it. Okay, if it's an expense that you can send to next year, and that will not hurt your operations, why not? And secondly, too, if you are somebody who sells on credit, then you have to encourage your customers to pay you, early. Because once your customers pay you early, you have the needed cash flow to do whatever you want to do, with. Then also, you must also try to negotiate better payment terms with your suppliers. You see, if you buy things on credit and you also sell on credit, you have to take the money from your customers before you can pay your supplier. And so we always say that you must give a shorter payment terms to your creditors, and give a longer payment terms to your suppliers, so that there wouldn't be any mismatch, or there wouldn't be any issue of credit worthiness when it comes to payment to your suppliers. So these are some of the effective cash flow mechanisms that businesses can put in place to ensure that at the end of the day, they remain credit worthy, whilst they also have the needed cash to do whatever they want to do with.
Right. Okay, but why is it important for businesses? You didn't mention it, but why is it important for businesses to ring fence money for January obligations? And what are the common mistakes owners make?
Okay, I like the word you use, ring fence.
Yeah.
You either ring fence it, or you use what you call Chinese wall. Chinese wall is a wall that cannot easily be broken. You see, generally, the first quarter of the ensuing year is always a difficult period when it comes to cash flow. And so that is why it is important that you monitor your cash flow and you don't spend everything in the month of December. Because in January, you are going to pay salaries. In that same January, sales may not pick up because most individuals and households, they have really spent during Christmas. And so sales may not really pick up.
Yeah.
So if you don't ring fence any cash flow for January, you realize that you get to January, sales are not picking up. Your cash is not there, and payment of expenses, most especially salaries, will become, problematic. And so it is always important that when you are in your last quarter of the current year, you do your cash flow projection to cover the first quarter of next year. So that whatever cash that you are expecting, you can ring fence it or use a Chinese wall, to actually fence it. In that case, when you get to January, you have a cash that you can rely on. But then if you don't do this, then you'll be compelled to go to the banks to go and take a credit facility. And if you look at the banking industry now, lending rate is more than 20%. And if you're an SME taking the loan at a rate of 20% to finance your daily operations, then that becomes problematic.
Okay, right. One of the things that you mentioned earlier is about actually deferring payments or delaying some payments just to be able to maintain their liquidity. Can't that create problems in the long term?
No, I don't think so. If you look at the expenses that SMEs or businesses in general they incur, there are certain expenses that are necessary, they are obligatory, they are, you have to pay them. For instance, you are looking at your PAYE, or your tax obligations in general, and you have to pay them, because if you don't pay them, penalties and interest will be computed on it. However, there are certain expenses, you can still defer them. For instance, you want to buy a car, getting to the end of the year, and you know that if you buy that car, it's going to significantly impact on your cash flow. That is an expense that you can defer.
Yeah, right.
Again, there are certain payment to creditors or your suppliers that you can negotiate with them that, this time around, my cash flow position is not good. So can we relook at first quarter of next year? So you have to identify the individual element of expense that you think are not really a priority for now. Then you can defer them. Of course, if they are due creditors or suppliers, then you have to negotiate with them so that you will not incur any issues of credit worthiness.
Right. Okay, we're going to talk about debt and financing as well, because you talked about some of the things maybe people are owing and all of that. But just let me announce the phone lines in case anybody's listening to us, they have a question, they can join the conversation. If you're tuned in, this is Business Breakfast on Z101.9 FM with me, Nitrebi Hammond. And this morning we're talking about how businesses can plan financially toward the end of the year. One thing that we've observed is that towards the end of the year, there are so many things that are happening. Businesses are giving some discounts, some giveaways and all of that just to stay active, and get people to come and buy and all of that, but they don't quite plan, and that's why we're having this conversation, so that you can plan very well, so that you don't struggle when we get into January. You can join the conversation. If you have any question, you have any comments, feel free to send it to me on WhatsApp on 0544321019, 0544321019, or you can engage me on Facebook. We're streaming live on Facebook at ZFMGH and on YouTube at Z Multimedia. Please do well to visit those platforms as well. Drop a comment under the posts and I'll read them for you. My guest is Nelson Kudjo Kwagbeji. He's a financial analyst and he is helping us break all of these things down. Okay, Nelson, let's continue the conversation. So we talked about SMEs. I said we're going to talk about the debts, but we'll come to that. We talk about SMEs. You mentioned them a few times. What strategies can they use to tighten their budgets without hurting sales?
Okay. Now, SMEs are normally classified based on their volume of sales. And so an SME that makes sales of, let's say, 500,000, his operation will be quite different from an SME that is making sales of about 2 million or 3 million. So one of the strategies that they can use to tighten their budget, as I did indicate, is to cut down on non-essential operational expenses. If the expense is not that important, you don't incur it. Okay. Then also, I also think that in order to boost sales and tighten their budget, they have to shift from a more, high marketing strategies to a more, cost-effective marketing strategy. For instance, the use of social media. The woman in Kantamantu or the woman in Domi Market, she may not be able to use social media for the sales, but businesses in general can actually rely heavily on social media. You get to realize that most businesses in Ghana now, they do online sales, which is cost effective because they don't pay anything for, or they don't pay much for whatever advertisement they do.
They do.
And also, One of the basic problems that SMEs normally encounter has to do with the preparation of account. You get to know that the small shops at the roadside, she doesn't really understand the concept of basic bookkeeping. And so whatever she sells during the day, during the week, during the month, she may not really take note of it. And so one way of doing that is to require the services of, people who understand basic concept in accounting to help in preparing their books. And one of the mistakes that SMEs normally do is that they equate profit to cash. Cash is not the same as profit. And so at the end of the day, the gentleman is having 5,000 cash balance at the bank, but he's making a profit of, let's say, 200,000. Then his head over is what? Is bloated. Meanwhile, all the chunk of the sales that he has made are on credit, and there is a possibility of default on the part of his, creditors. And so once they understand some of this basic concept of bookkeeping, cash not being equivalent to profit, cutting down on their non-essential, expenses, and also leveraging on social media to boost sales, I'm sure they can tighten their budget without really hurting their sales.
Okay, right. Now, one of the things is also reviewing expenses. When reviewing expenses from the past 11 months, what specific red flags should business owners look out for?
All right. So this is where the comparative analysis comes in. You must always compare what you have budgeted or what you have targeted to do against what you have actually, done. It is only when you do that you get to know your actual effective expenses for the period. You also know your actual and effective income for the period. And then also, businesses normally don't categorize their expenses that are recurrent and expenses that are non-recurrent. For instance, if you buy computer for your operation, you will use that laptop or computer for a period, let's say 5 years. So you don't recognize the total cost of that computer in the year in which it was bought.
Right.
But because they lack the basic understanding of some of these things, they will actually incur or recognize the 20,000 that they bought the computer in the year in which it was incurred, and that actually reduces their profit. And so, in order to prepare for the review expenses for the current year, they have to identify expenses that are recurrent in nature and expenses that are capital in nature. And of course, they must also make sure that they spend within the budget, because when you spend over and above the budget, then that becomes problematic.
Okay, right. Okay, let's move to the debt situation, the debt conversation I said we're going to talk about. Now, should businesses, do you think that businesses should consider clearing their old debts around this time before the year ends? Or is it better to restructure and carry them into the new year?
Okay, when you borrow money from the bank, you are given a payment duration. Let's say you incur the debt in the month of June and you are supposed to pay within 1 year. By the end of December, you would have done, 6 to 7 months into the loan, duration. Why do you want to pay all the loan at the end of the year when the contract that you signed with the bank entitles you to pay month on month till next year, May or June? And so I don't think that it will be prudent, but these are cases that we can analyze on individual basis.
Right.
A company A may say that, well, this time around I have an unexpected cash flow and that is just sitting down there. So why don't I use it to offset my debt? Another company will say, okay, fine. Even though I have the cash, the contract I signed with the bank says that I should be paying month on month. So I have done 6 months this year, and next year I'll continue paying month on month. So some of these things we can look at it on individual basis, company by company.
Okay, but so if you can, just let us, share with us how, the difference or some of the for lack of better words, some of the various scenarios that may come up, and how the business can actually handle that. So maybe like you can give like two or maybe two examples of maybe company A, company B, a situation like that, so that we can look at it.
Okay. So when you need financing through debt, you go to the bank. The banks these days, what they do is that you can go to the bank and say, okay, I need a loan. But when the bank looks at your operation, they will tell you that no, with the kind of business you do, you don't really need a loan, but you need what you call an overdraft. So the bank will look at your operation and then give you what they think will be good for your business, what will make you repay the facility easily without defaulting. Now let's take two companies. Company A is somebody who sells on daily basis. Okay, he sells on daily basis. Let's say it's a supermarket. When you are operating a supermarket, you don't need a loan. You need an overdraft, because the overdraft is like a debit balance that will be, given to you. And then every day, as and when you sell and you pay the sales into your account, then the balance reduces. So that one perfectly fit for those who actually do business on daily basis. But let's take somebody who is a contractor, for instance. He has been offered or awarded a contract, and he needs a facility to work on the contract. That gentleman doesn't need an overdraft. He actually need a proper loan.
Right.
Because at the end of the day, you have to work up to a certain stage, raise a certificate for payment to be done, then you pay the bank. But then if they give you an overdraft, you realize that the debit will keep on increasing in your account. And so it's on individual basis. The nature of your business you are doing will determine the kind of facility that the banks will give you. Don't forget, sometimes the banks, they are not so much interested in how much they will give you and how much they will earn. Some banks, they have it as part of their strategy to help SMEs to grow. And so when you go there as a contractor and you tell them you need an overdraft, they'll tell you don't need an overdraft, you need a loan. However, even the loan, this is how we can structure it in order to suit the kind of work you are going to do.
Right. Okay. So still talking about debt now, for businesses that are actually specifically considering loans to restock during this festive season, how can they determine if borrowing is truly necessary?
Well, if you want to restock, the idea is that you either have your own money, or if you don't have your own money, then you go to the bank. I mean, restocking is normally done, not necessarily at the end of the year, because at the end of the year, you are actually taking value of your stock. So on case-by-case basis, you will see companies actually, buying for consumables, yes, because people will need to buy things for Christmas. But for a typical company that their products are not really needed for Christmas, you don't restock at the end of the year, because when you restock, what will happen is that you just have your stocks lying there and nobody will be buying them. However, if you are somebody who are into consumables, you can restock with loan, provided that the interest that you are getting at the bank will not be something that will hurt your operations. Every business needs loan, especially if you are not having your own fund to operate with. And so they can still go in for the loan, but the interest that they'll be paying or the cost of capital that they'll be getting from the bank must be considered very well, in order not to choke themselves with so much debt that the payment will become problematic.
Okay, right. But are there any tax or maybe regulatory considerations that businesses need to keep in mind around this time?
Of course, yes. I mean, every business in Ghana is registered and regulated. When I mean regulated, I mean the company's law or the company's code is what regulates businesses in general. And so as you are getting closer to the end of the year, you have to go back and make sure that all your tax obligations in terms of filing obligation, in terms of payment obligations are met. Because there are some specific dates within the month that you are supposed to pay certain categories of tax. So you have to go back and check if your VAT or your PAYE or your withholding taxes have been paid on time. Then also at the beginning of the year, businesses are supposed to file what you call self-assessment. Self-assessment simply means that you assess yourself and determine your revenue and, for that matter, your tax obligations for the year. And so you have to make sure that your taxes that you have paid within the year, most especially your corporate income tax and your growth and sustainability levy, are within the threshold, so that you don't underpay, because when you underpay, there are certain penalties that GRA will slash on you. So you have to look at all the deadlines of your tax obligation, payment obligation, filing obligation, and make sure you actually satisfy them.
So what are the risks of avoiding or not doing all these things?
Well, certainly, when you don't do these things, the tax authorities will come after you. You have to pay the penalties, you have to pay the tax itself, you pay the penalties, and you pay the interest that will accumulate on the delayed payment. And don't forget that penalties in general are not deductible expenses. I mean, there are certain expenses that, from the perspective of the taxman, they are not deductible. One of those is penalties. And so if you are preparing your account and you deduct penalties from your income in order to arrive at your profit, when the taxman comes, he tell you, my brother, penalties are not directly linked to the production of your income, and for that matter, I'm going to disallow it. And so if you don't do some of these things, the taxman will come after you, you pay penalties, you pay interest, and that will hurt your bottom line.
Right. So businesses listening to us this morning, I'm sure you're picking a thing or two from all the things we've been talking about so far. I mean, it's not just. I think it's not just about also planning for the end of the year. Another important aspect is also planning for the new year around the same time. How important is that, Nelson?
Please come again.
So I'm asking that how important is also planning for the new year right from now?
Yeah, it's very important. I think we've mentioned it already, that it is important because, I mean, there are expenses that you have to incur in January. And we've also seen that in January, normally sales are very low or slow. I mean, because we've spent all our monies in December. So if you don't plan towards January, it means that you'll be having some issues. So one of the things that we mentioned earlier is to ring fence some of the income that will come in. You reserve them for January. And also the discounts that you will be giving, you must monitor them to make sure that they don't hurt or affect your sales. Then, of course, as I did indicate, one of the things you must also do is that you must also make sure there is a clear mismatch. There is a clear match between your creditors and your suppliers, so that your suppliers will not put pressure on you once you haven't also received any receivables from or any income from your creditors. And it's very important, because if you don't do this, and you don't have the necessary cash, you may end up defaulting on some of your statutory obligations. For instance, payment of SNIT and GRA obligations. So it's very, very important that in as much as we want to enjoy December, we must also make sure we reserve something down for January.
Right, but are there some financial metrics that businesses or business owners should monitor closely at this time?
Of course, yes. I mean, it is based on those financial metrics that you know whether you are doing very well or not. I mean, we mentioned one earlier that has to do with your variance analysis, where you compare your actuals against your budgeted to know whether you are actually doing well or you are not doing well. If you are doing well, what are some of the factors that actually contributed to the significant rise in your sales volume? Is it the discount? Then once you get to know those factors, then you try to sustain them going into the new year. However, if you also get to know that based on your variance analysis or your comparison between the targeted and then the actual, there is an issue, then you have to dig further to actually know what exactly contributed to the negative variance that you have recorded. Then, of course, you must also compare your expenses to your income. I mean, if you don't have the income, you can't spend. So you have to know what quantity or what quantum or what percentage of my income has gone into expenses, most especially staff related expenses. Then, of course, you must also make sure you also compare your bank balances to your cash balances to your immediate obligations. If your immediate obligations far outweigh your cash balances, then it means that there is a problem, out there. Then you must also compare your receivables to your payables, your creditor suppliers analysis to me. So these are some of the metrics that SMEs or business in general, depending on the sector they are in, can use to actually monitor their operations by the end of the year.
Right. But apart from the metrics, are there some financial habits as well that businesses should carry into January so that they can avoid the new year financial shock?
Please come again.
So yeah, I'm asking that apart from the metrics that you've given us that you have to monitor, are there some financial habits, that businesses should carry into January so that they can avoid the new year financial shock?
Oh, yes, of course. I mean, whatever the business owner is doing, that is contributing significantly to the gains that, he has chalked. It should be continued and sustained into the new year. And if there are certain habits or expenses that are inimical to the growth of the company, for instance, getting to the close of the year, the business owner will take some 500,000 from the business account to travel with it on personal basis. That is going to hurt the fortunes of the company. So anything that the business owner is doing that is actually helping the business to grow, it should be sustained into the future. And on the contrary, anything that he is doing which is inimical to the growth and sustenance of the business, I think it should be avoided.
All right. So 37 minutes after 9, this is the Business Breakfast on Z101.9 FM. And this morning we're talking about how you can plan, how your business or our businesses can actually plan financially toward the end of the year. And my guest is Nelson Kudjo Kwagbeji. He's a financial analyst. And we've had a great conversation so far. We have just a few things to touch on. But if you just joined us, you can also get in touch with us on our social media platforms. We're on Facebook at ZFMGH. And also on YouTube at Z Multimedia. Drop a comment under any of our posts and we'll read them for you. If you have questions, feel free to send them and we'll read that for you. And also you can send us a WhatsApp on 0544321019, 0544321019. And I give you the opportunity to be part of the conversation. You can also call us on 03039566641, 03039566641. The phone lines are opened, and so if you have any question, feel free to send them. All right, a few of the comments that have come through on our WhatsApp. This one is from Joseph. It says that if I am struggling to be able to generate revenue, do you think I should go into promotions? I think this is something that Nelson has spoken about, right? But Nelson, you may want to respond to that. Hello, Nelson.
Yes. So as I did indicate, if you are struggling and you want to offer, promotions, discount, and all that, you should do your cash flow analysis. You wouldn't just stand up and say, okay, because I'm not selling, let me give discount. You need to know that if I give a discount of 2%, what volume of sales must I do in order to make this quantity or this volume of this value of sales? And so it should be done on case-by-case basis. Most companies give discount not because they are not doing well, but because they just want to increase their volume of sales. And so if you are struggling to sell, but you think giving discount to customers to boost your sales, why not? But you have to do that carefully in order not to, worsen your position.
Okay, right. I hope that Joseph, you got your answer there. Okay, let's look at. Okay, this one is also from. It says that are there apps or tools? Okay, we're going to come to that shortly. So Nelson will provide some apps and tools that we can use to plan your year. All right. This also comes from Daniel. Daniel from Kaswa says that how can I make sure I have enough money for January obligations like salaries and taxes? I think he also you already talked about that as well, but maybe you want to respond to that before we move on.
Well, I mean, you just have to be very prudent with your spending in December. If you are not prudent with your spending in December, then you are going to surely have a problem in January. And so, I mean, prudence is key. As I did indicate, if there are certain expenses that they are non-essential, I mean, you can defer them to next year in order to meet your, obligations for beginning of the year. And that is very important because when you spend everything end of year, when you start a new year, you will have challenges. So all non-essential expenditure, items should be deferred into the first quarter so that you can reserve some cash flow for January and February.
All right. The other ones, this one says that great conversation. You didn't add your name. Great conversation, and also, okay, this. Let me just avoid this one. All right. So, Nelson, let's continue. We want to touch on some other things, and then we can go. Now, many companies actually pay bonuses in December. How should businesses plan and budget for that without destabilizing operations?
All right. I mean, bonuses are normally paid to most especially outstanding members of staff. And if you know you are going to pay bonus at the end of the year, then the preparation must be done at the beginning of the year. So you must also make provision for that in the budget. There is a principle which says that if it is not in the budget, don't spend it. And so if you know you are going to prepare and pay bonus to staff, then of course, I mean, from the beginning of the year, you must start making provision towards it. And so you can even create an account where, I mean, month on month, you try to put something there so that when you get to the end of the year, you may not have challenge, paying bonuses. So, I mean, these are some of the things you can do. Just make sure that you plan towards it, it is in the budget, and you make provision for it month on month or periodically as and when cash flow is, you have enough cash, you can make provision for it so that when you get to the end of the year, you can have something that you can lay your hands on to actually pay the bonus to your staff.
Is that to say that it's too late for any organization should be thinking of paying bonuses around this time?
No, I don't think it is too late. I mean, even some companies, they pay bonus based on sales volume made by a staff. And so it is at the end of the year that the sales volume will be determined and the percentage that the staff will earn on that sale. So I don't think it is too early. But for you to be prudent, it is always important you budget for it. So once you budget for it, then you can make provision towards it. But then if you don't budget for it and you have to pay at the end of the year, then that is also going to distort your operations in terms of your cash flow, your expenses. So it is always good you budget for it at the beginning of the year, you make provision towards it, then at the end of the year, you can have something that you can rely on to pay the stuff.
Okay, I see. So what will be your advice on controlling operational costs as well? I'm talking about utilities, logistics, and inventory. I mean, during this, this busy but risky month.
Yeah, so utilities are integral part of the, expenses that businesses incur. I mean, you can't run a business without paying for electricity. You can't run a business without paying for water and all that. So, I mean, it is always good that, in some companies, if you are leaving the office, you must make sure the ACs, the light, everything is turned off. I mean, if you are not in the office, why do you leave your AC on? So, in order for you to control those inflationary expenses, there must be a close monitoring of how the staff use those staffs. Because at the end of the day, if the lights are on when business is not in, you are not working, you are just incurring unnecessary costs. So, I mean, those are costs that are controllable. We call them controllable costs. And to the extent that they are controllable, management must do everything possible to make sure that they don't unnecessarily incur those costs that could have been, controlled. So if you are not using the AC, turn it off. No matter how insignificant it is, cumulatively, it may increase your utilities.
Right. Okay. So let's now talk about the tools that the gentleman was asking of. What tools, or maybe putting it differently, are there some financial systems or softwares you would recommend for small businesses to improve tracking, planning, and also maybe accountability?
I mean, of course, we have so many of them in the market. So many of them. The list is, we can't even exhaust the list. So the list. And so what is important is for you to identify you don't really need software. If you are a small business, a clearly defined Excel can even help you. And so you just have to know the kind of business you run, the kind of thing that you want the software or the Excel to do for you, and then you go to the market and you get them. I mean, there are so many of them that are in the market. Even if you ask an IT student at the university and you explain the concept to them, they can actually come out with a very good Excel that you can use for your operation. Don't forget that the tools that we have in the market, those things are very expensive. And so if your business is not doing well and you go in for something that is so expensive, paying for it will be problematic. And so you identify the kind of business you are into, the nature of your business, and you go and look for the software that can suit your operation, but then, of course, at a minimal cost.
All right. But there are some online as well that people can download.
Well, of course, the internet is full of so many things. So, you can get so many of them online. But then the effectiveness and the efficiency of it is what we may not know. And so it is always good you try to buy it from somebody so that when you are having any issue, you can call on that person for maintenance.
Okay, our time is almost up. We just so what are some practical low-cost steps that businesses can take now to protect profits and also avoid losses?
Okay, so I think we've discussed some of them already. We must implement strict spending controls. If the expenditure is not necessary, you don't have to spend or incur it. Number two, you have to also track your daily, expenses. Okay, you have to, track your daily expenses to make sure that you monitor all the expenses periodically. Then, of course, basic bookkeeping principles are key. As I did indicate earlier, there are so many, SMEs who don't actually keep a proper book of account, and that normally impact on their operations. And so, bookkeeping is very, very important. And so, if you know you don't have the skills, you can just seek an expert advice or somebody with the fundamentals in accounting and finance to actually help to structure your operations. And also, you must also make sure that you meet all your statutory obligations, because if you don't do, they come in form of penalties and interest, and that will also impact on your, operations. And then also, if you are into sales on credit, you must always make sure you have a good payment terms with your creditors and your suppliers, so that at the end of the day, your suppliers will be on your neck whilst your creditors don't have money to pay. So you must always make sure that you negotiate the payment terms very well in order for you not to have any problem.
Right. Okay. Nelson, I think we'll wrap up here. I don't know if there's anything you want to talk about that we haven't spoken about already. Then you can share that with us, and then we can go.
Well, I think we've exhausted everything. The most important thing is that we must make sure that whilst we are entering the new year, there are obligations that needs to be satisfied. And if you don't have money, it means that you have a challenge. So in as much as they are all yearning to spend Christmas very well, SMEs must make sure that at least they reserve some cash down for expenses to be extinguished in January, February, and March, considering the fact that sales normally are slow when we start a new year. And so when you spend everything this year, when you enter the new year, you may have some challenges. Then again, they must also try to, satisfy their statutory obligations in order not to incur any penalties from any regulatory body.
Right. Okay, Nelson, thank you so much. Really grateful that you joined me. I think it's been a very, very insightful conversation. You've given a lot of value, and I'm sure any business that listened to us this morning would have taken note of quite a number of things. Thank you so much for your time.
Thank you for having me once again.
All right. Okay, so that was Nelson Kujo Kwagbeji. He is a financial analyst, and he joined us this morning on a roundtable discussion. We've spoken about a lot of things. If you're a business owner, you cannot fail this year. Yeah, not at all. I don't think you can, because we've talked about why financial planning is very important. You've gotten to understand some of the strategies you can use to actually tighten your budget, how you can manage your cash flow effectively, and all of that. If you missed any part of this interview, you may want to visit our social media platforms, because this is a lot of value from Nelson. So visit our social media platforms. On Facebook, we're at ZFMGH, and on YouTube at Z Multimedia. I'm sure the video will be posted on both platforms, so you may want to go and play back and make the right decisions around this time, because we are all concerned about your business. We want to see you do well, and that's why we have conversations like this from time to time, so that you can do well. If you succeed, we also get excited. So thank you very much for staying with us right here on the Business Breakfast on Z. We'll wrap up now, and I think that's how we wrap up today right here. We'll be back again tomorrow. Tomorrow we have some other interesting conversations that we're going to have, and so you may want to tune in tomorrow at exactly 6:15 a.m. and let's have a conversation right here on the show. Until then, please take very good care of yourself, and when you think Ghana, think